Shopify is one of the largest e-commerce platforms in the world, and its stock is up almost 300% over the last 5 years. That's despite dropping 70% from its peak. At the current share price, Shopify has a market cap of $69 billion. It's got $7.9 billion of cash and investments and $900 million of debt, so the enterprise value is $62 billion. Revenue over the last 12 months comes to $6.3 billion, but the company is still not profitable. Adjusted ebitda is negative $1.6 billion and net income was minus $2 billion. Some of those losses come from a significant amount of stock-based compensation, around $700 million over the last 12 months, and that will continue to dilute value going forward. So Shopify stock is currently valued at 10 times revenue, 500 times free cash flow, and we can't measure the PE ratio because the company is producing negative earnings. Does this mean Shopify's business model is broken? Well, no, 20% of revenue is being spent on sales and marketing and 40% on R&D, so Shopify is still investing for future growth, and it's had a lot of success in doing so. Revenue grew 86% in 2020, 57% in 2021, and 21% last year, and there's plenty more room to expand. However, to stay competitive, Shopify needs quick delivery times. Its $2 billion investment in fulfillment network Deliver was a failure and had to be sold at a loss. Instead, Shopify is partnering with Amazon's fulfillment network by allowing the Buy with Prime button across the Shopify network. This partnership should benefit both parties by boosting Shopify's growth while giving Amazon a cut of payments. But this news has also helped Shopify's share price over the last few months. Let's assume that Shopify can continue to grow top-line revenue at 20% per year for the next 5 years and then operate with a net margin of 25%. In that scenario, the company would be producing $3.9 billion of net income in 5 years' time, give the company a 25 times multiple, and the valuation would be roughly $98 billion, which works out to an investment return of 7.3% per year. However, that's a very aggressive forecast, and it doesn't yet take into account dilution of shares from stock-based compensation. Overall, there is a clear need for an alternative e-commerce option to Amazon, and Shopify definitely fits the bill. But a lot of future growth is already priced in, and there's no question who the dominant player is in e-commerce and fulfillment. Shopify will do just fine as a business, but it doesn't look like a compelling investment choice, which is why I give the stock a negative rating. But these are my personal opinions, not financial advice, and I've got no position in Shopify stock. For more detailed investing ideas, make sure to check out our website, overlookedalpha.com.